Everybody, this is Jim with the optionprofessor.com, and I'm going to go over some information in the next hour and share with you some thoughts, observations, and opinions, and things that I have discovered over my decades of being around the markets. And basically, at the end of the broadcast, I'll explain how you can get a weekly update from Option Professor on a weekly market update. But I'll get into that at the end of the broadcast. Okay, what I'm going to do here now is I'm going to start out by basically saying my opinion on what's going on now. Let's start out a little earlier, though. First of all, I'm showing you a long-term graph here, 20 years, okay? So you can see the market was in a very nice uptrend ever since the crash of '08, and then it got a couple of, shall we say, violations here, but not much. Then a big violation, and then the Fed put in 44% of GDP of stimulus to get that thing back above the blue line. You got to know that Mnuchin, you got to know that Powell knows exactly what these charts look like. And they know that if the chart starts bending down, it can be years before it comes back up. See, during the crash of '07, '08, it was what? Down all of '08 and most of '09 before they got it back up. And then it never got back to the high all the way until 2013. There's no way that those guys were going to let 4 years go by before they got it back to the high. They know their political lives will not last that long. So basically, 5% of GDP is what the Fed used in the crash of '08. 44% and counting is what they've used this time. So they're totally off the grid as far as how much money they're putting into the system to get asset prices up. So that's a good indication. The other thing on a long-term basis that's somewhat concerning, I might as well get over this right now before I go into anything else, is that on the long-term graph, you see you're making big highs up here, but where's the new high on the RSI? Not yet, right? So some people think we're going to 3,600, 4,000, 4,200, and that could very well happen because the RSI is down here at 61. So there's plenty of room to go up. But the thing that would be concerning if we started to take out 3,200 and 3,000, and if we ever took out the 3-year moving average, which is at 29.10. There's your moving averages. 31.41 is the 1 year. 2 year is about $3,000. And the 36-month 3 years at 29.10. So if we ever started taking out 29.10 and this thing had that big of a high point, with that kind of divergence on RSI, that would catch a lot of people off guard because nobody's thinking we're going back down to 2,800. But anything can happen, as you found out 6 months ago. So basically, we're at a very critical point here. You know, I'm still thinking that it's going to hold these green, red, and blue, well, at least the green line for sure, right? Come 29.93, 29.63, something like that. You know, that low point there. 29 right there. So basically, you know, the market is uptrending, and obviously that's why being long makes so much sense. But, you know, you've been hearing all about different types of trading and different stocks that look like they could be good and this and that. But I wanted to give you a little bit of a broader scope on how I go about looking at these things sometimes with regards to, you know, how to invest and how to speculate. With regards to the ways to go, you know, you can break it down into growth, income, and speculation. Those are the three things you're doing when you're investing. When you're buying stock, you're betting on the company's future earnings, you're betting on the valuation, and you're betting on momentum. Whatever you're betting on the company and their ability to make money or how much people will pay value-wise. Number two, with income, you just want the cash coming in. That's what you want. You want income, and you'd like to get paid back your principal, right? And the third thing, speculation, is obviously you're taking a guess, and you hope the guess will work out. With regards to how to approach each one, on growth, obviously the big thing this year, which we saw early in the year, March and April, was tech. Because you could see that people were not going to be able to go about doing their normal processes. So that was going to open the door for things that facilitate business and interpersonal communication digitally. Okay, and that's what it's happened, e-commerce and digital lifestyle. So we saw that, and if you've read the newsletters that we sent out in March and April, you would have known that I look at a lot of the Vanguard ETFs because they're very large and they generally have pretty high quality stocks in them from the standpoint of larger cap, that kind of stuff. So I was looking at their mega cap growth. I was looking at the SMH, the semiconductors. I was looking at consumer discretionary, because a lot of this consumer discretionary, you know, the consumer is not going to not spend money. They always spend money. Even if they don't have it, they spend money. What Pelosi's trying to say is, give us the stimulus bill, we'll give these people money and they'll spend it, which means the economy will get going. You'll get the money back. Just let them have some money. You saw what happens now when they take away the $600. Right? The $600 supplemental has been taken out and the economy is stalling and the economic numbers are turning over and things like Open Table have rolled over and Booking.com has rolled over and things like the hotels are seeing it roll over. Okay. And we just saw durable goods roll over. Right? So the bottom line is they took out that extra payment, and that extra payment meant a lot, and because those people were taking that extra payment and they were spending money. And they were getting the stuff delivered by Amazon, right? And they were getting the Peloton bikes, which have like a 2-month wait on some stuff, and you can't even get the bike itself, I don't think, right? And then, of course, everybody wanted to have a meeting, but they're not going to fly anywhere, so they're going to Zoom, right? And they want to go see the doctor, but they want to do it over the internet, unless it's something you have to go in and see them for. So here comes Teledoc. And then they got to get these documents signed and stuff, right? But they can't go out and get these people, so they go DocuSign. All right. So we saw that coming in March and April. And if you got the weekly updates, you were on top of it like white on rice. Now, after that, we looked at things of value and epicenter stocks. I mean, we weren't saying to buy the epicenters at the lows, but after they made the turn, you could see the rent-a-car company, you could see the hotel companies, you could see the leisure companies, you could see the companies that, were just the cruise lines, were all at a point where they were turning up. And ergo, you got a nice run out of that. Also, you got a decent run out of things like the banks and the energy stocks for a while, right? That was in our time frame of what? April, May. Then in June, July, we turned our attention to the metals. Why? Because the dollar peaked in March at 104 and it went way down about 12% during the time frame of March and September. During that time frame, the gold and silver went nuts, the stocks went nuts, and everything went nuts that had anything to do with the dollar. Emerging markets got a good bid, etc. Okay, but what's happened after September 1st? The dollar stopped going down and it's had a rally. And what has happened to the stocks? They've been giving up the gains. What has been going on with the gold and silver? They gave up their gains and they're in corrective modes. And because that $600 was not put in, we have got a situation where we still got almost 12 million people getting unemployment. We still got 900,000 of new claims, which are higher than the high point of 2008. Now, again, we talked to you about in the newsletter in March and April, people are wondering, how's the stock market going to go up? We told you how it was going to go up. It's going to go up because they're not going to hire these people back. And they're not going to take as much real estate. And they're going to save on all these meetings where they had to buy hotel rooms and flights and meals, etc. Okay? And so their expenses are going to go down. And even if their earnings or their revenues are not what they used to be, you're going to do revenues against lower overhead. And my third grade education on math means that you could get back to peak earnings pretty fast if you take lower revenues, but divide it into what? Much lower expenses, right? Right. So that's why we've had a very nice recovery in the earnings front. But the easy work has been done. What do you mean? The snapback rally has been done. The overvaluation of the tech sector has been done. And now the road is getting a bit rougher. It's not as easy for these markets to keep making higher highs all the time, right? And there's no stimulus coming down the pike. Okay, why? Because again, one group doesn't want the amount of money to be such and such, and the other group wants it to be more because they don't want to keep coming back to the well every 5 minutes because they can see we have possibly structural stimulus needed. Structural stimulus. You know, if you think your knee hurts and they tell you you have a structural issue, that means they got to go in and work on the actual knee bone. Okay, if you have structural stimulus in the future, that means there's going to be permanent stimulus going out to take care of these 12 million people that are not going to get rehired. Or if they get rehired, it's probably not at the same wage they were getting, all of which can hurt your consumer spending. And that can't get the economy going. Now, in addition to what's going on now with the consumer, who is obviously, you know, possibly slowing down a bit, ergo the credit card information, right? The credit card data is slowing. I already told you about OpenTable. I told you about bookings.com, et cetera. But the situation is also that these guys are not having jobs to go right back to. And that means this lull could last a little longer than you think. Okay, so stimulus not showing up is a big factor right now. And then you've got the election. I mean, I don't have to tell you guys what that melee looked like the other night. And I don't need to tell you that the likelihood of Donald Trump saying, I lost, have a good day, I'll get the stuff in the truck, is not probably a high probability, because he's got AG Barr in there and he's got the Supreme Court going. So that, you know, there's a real potential mess there. And then, of course, you've got the banks. Where is there going to be a shoe to drop? Now, they've put a lot of money aside for bad losses. But if they really started to come down the pike, and generally it takes 6 months of non-payments before they turn them into bad losses. So we're just getting into the time zone where if things are, the wheels are going to come off the bus, that we're going to find out about it. Now, like I say, in addition to the stalling out of the economy that we're seeing now, we have another thing going on, and that is the ridiculous jump in debt of corporate America. These guys are rushing like front running this election like Bolt down in Jamaica. Anybody who doesn't know Bolt, he's a very fast guy out of Jamaica. Anyway, why are they doing that? Well, because these rates are a joke, and people are so desperate for yield because the Fed put any treasury rate down underneath 1%. Who's gonna want to lend money for nothing, and who can live off nothing? Nobody, right? So there go. Let's get into the investment grade, which the Fed is essentially backing. So people are buying investment grade like it's money market. It's not money market. And then they are also going down the risk meter. And what are they doing? They're going into the junk bonds. September, record issuance, record fundraising, okay? Triple C's, we're doing very, very well. So people are not even going triple B anymore, double B, single B. They're going into the triple C pool. Now, again, what's the problem with all this debt that's being created in the corporate sector? If earnings were to not be there ahead, then the leverage these guys are using is going to be twice as bad as it is now. And it's bad now. Some of these companies are extremely leveraged now. And if their revenues and earnings do not come in, well, if they're leveraged to the hilt now, what is to the hilt times whatever, if their earnings and revenues don't show up? So you've got a huge corporate debt bubble that's being created. Now, again, there's two sides to every story. If in fact they do get the earnings and revenues, then they might be able to come out of this thing because the debt service, because the yields are so low, could maybe not be so bad. But there is a risk of that, and that's what we're talking about. So again, you know, our view at optionprofessor.com was that the market peaked out there around 3,600 and that the market's on the defensive. And the move to 3,200 was one stop, and it's bounced very nicely up. But it has not gone back above last year's high, which is 33.93, and it has not taken out the middle of September high of 34.28. Those are our two key points, okay? If they start getting above mid-September high, 34.28, that would be something that we'd have to change our view a little bit. But our view is going to remain that this is still an unwinding, as we told you back in July and August, that September, October, and November is a danger zone. Well, September gave you some pretty good sell-offs, so that was pretty accurate. And just because there was end of the quarter window dressing and some people doing some short covering at the end of September, let's see what this October does, okay? Because even if they pop it a little bit in the beginning because people need to buy something or whatever, let's see if it can sustain itself in the month of October as the news comes out. But we are still of a belief that September, October, November are dangerous months for the stock market. And rather than buying in the middle of a snowstorm, we would prefer to look to buy either at great discounted values, not great discounted, but discounted values, or if we're wrong about discounted values, get in when they start taking out the higher points. Now, a lot of people, like I say, got into Apple and Tesla because they were splitting. We explained to people that if I give you $5 and you give me 5 singles back, I'm not any richer. Anybody who understands basic math, that's what a split's all about. So stampeding into Tesla and Apple, we told everybody in our letter, seemed like a bad idea, and it was a bad idea. Apple dropped as much as 25 or 30% off the high, and Tesla's really got whacked as well. So again, in the newsletter, we do give our opinion and our view and our observations on things, and that was one of the things you could have gleaned from there. What do you do when things are frothy? What do you do when they're way up? You look to defend yourself. How do you defend your money? Well, there's many ways of doing it. Our opinion is a couple of ways to do it would be to sell some calls. What do you mean? I mean, the stock's up at 140 or so on Apple. What is the 150, 160s looking like? 170s. You know, Tesla was at what? 500 bucks, 600 bucks, whatever it was. What are the out of the monies going for? Or a little bit out of the monies. That's one thing. Covered call writing. Take some cash in. Then when it drops, at least you got paid a little bit of money. Now, what about collars? Well, how does that work? Well, that means you're going to sell an out of the money call, take the premium in, and then go buy put insurance underneath. So as a theoretical example, right? Let's say Apple was 140, just to use a number. Say you sold the 150 calls and you got $5, and you bought the 130 puts and you paid $5. When it drops to 103, you've got a right to sell it at 130. That's $27 to the good. And what'd you use to buy the put? You bought it with the money that came out of the call. Obviously, that would have been a very good idea in hindsight. What's the risk to it? Well, the risk is opportunity risk if the market gets above the top strike price. Other than that, if it stays in between the two strike prices, they both can expire at 0, and it's no harm, no foul. But the collar strategy, again, is for people who are trying to protect their assets from a market decline. And it's best to be done, obviously, at a higher price. But sometimes it can be done at any price and be a good idea. But, you know, ideally, you're going to try to do it when the prices are fairly high. The other thing you can do to protect yourself when the market's very high is you could use married puts. Just buy a put. For God's sake, you're up $50 on the stock. Throw $5 into a put. So you lose the put. You're still in the stock, right? So look at married puts. And then another thing they do is they do a replacement trade. Let's say you owned Apple and it ran all the way up to 140, right? And say you bought it and you were up $40 on the stock, but you think it might be getting frothy. So you get out of the stock and say you got a $40 gain, and you take $5 or $10 out of the $40 gain, you buy calls. If the market keeps going, at least you've got a position going. And if it goes in the tanker, you've sold everything except the premiums on the calls. That's called a replacement trade. Also, trimming. What is trimming? Trimming is where you obviously own a lot of shares and you take some off the table. You trim it. So there's things to do when the markets are way up, and you have to have some idea of what you're doing before it gets there, so you're not scrambling through brochures and making sure your suitability is there, and make sure your approvals are there and your money's there, and you've talked to your tax man and all the other many factors that have to be talked about before it occurs. Now, what are some of the strategies on the option side when the market goes in the big tank? Like we just hit 3,200, it was a pretty good drop, right? What, 3,580 down there, let's call it 3,600 down to 30. That's a $400 drop, 400-point drop on the S&P. Some stocks were really going. Well, if you like a company and it's tanking and you have the cash in your account You could look at the put side. And what is a selling of a put mean? Selling of a put means that you agree to buy the stock at the striking price, and they're going to pay you a premium. Who's going to pay you the premium? The guy who bought the put. You're the seller. So you take in money, and then what are you obligated to do? You're obligated to buy the stock at the strike, less your premium, and that would be where you'd have to come in. So we just saw Apple go down to 103. What do you think the $100 puts were going for when Apple hit 103? 10, 15, depending on how far out you went. So you went to December or January of next year or March of next year. You can sell time if you want. And let's say you did sell the puts. Well, obviously, it never went to 100 now, so you're not getting any stock. But with this rebound rally to 116 or whatever, those puts are shrinking. Now, you'll keep the put money if it never goes down to 100. But if it goes down to 100, you'd have to buy the stock if it's put to you, minus the premium. And that's what some people like to do. Now, the more aggressive player, what does he want to do? He wants to sell that put, but he wants to take that put money and he wants to spend it. And if he's bullish on the stock, he just thinks it's temporary that it's down. He's going to take that put premium and he's going to buy the stock. Call. So let's figure that one out. Now, again, you own the stock after it's put to you and they take out and you credit the premium. You own that stock at that cost basis. If it keeps going, you're in the Titanic as far down as it goes. So there's a risk, and you own the stock. The risk is it keeps going down. But if you're a long-term bull, that's going to be part of the game. Now, what if you want to take that premium and use it to buy calls? Not a bad idea in some cases. Now we're down at 103 on Apple, and the 100 put is going for 10. As an example, pick your own expiration date. We're just talking theoretical. So you get $10 on a put at 100. Now you look at the 105 calls. They're going for 10. So you buy the calls for 10 at 105. Now you've agreed to buy the stock at what? 100. And you have the right, but not the obligation to buy the stock at 105. Stock jumps up to 115, 120, whatever it's going to do. You're in at 105. That $10 you had to pay for the call was actually paid for by the put that you sold. And now you got to look at the 105 strike until the expiration date. So that's another way of using options at different points on the market. And if we do get the lower levels, again, the 1 year, 2 year, 3 year moving averages are the areas that I am looking at. We are looking at. And that is going to be 31.42, 29.94, and 29.10. So, there they are. And you can see over time, they sometimes come back to them, right? Let's go over that. 09, it got above it, came back. Got above it, came back to the red and green. Came back to the red, came back to the red and green. Came back to the red, green, and blue. Broke it a little bit, but if the direction of the average rises, you don't want to get negative here, okay? Not necessarily, because the movement of the moving, that's what made me constructive and us constructive on the market when it went way down here, because we felt, and I think properly, that the Fed was going to come to the rescue, printing money like crazy and buying everything they could to support it. And once they did that, that's March, that's April, and by May, you're what? You're back above it, and the average never turned down, and the averages never crossed. And that's why these averages are helpful to me. They take a lot of emotion out. I don't want to be buying stock up here at the high. I don't want any part of 3,600. Why? Because the averages are down here. You heard of reversion to the mean, reversion to the mean? That's what they're talking about. So basically, that's a little bit of the philosophy of, how to approach the markets and how to maybe use option strategies when it's appropriate to do them. I mean, if you're trying to drive a nail, that's the time to pull out the hammer. Not the time to pull out the screwdriver. Not the time to bring out the rake. You're trying to drive a nail. You got to use the right tool on the right job, right? And be patient. Everybody, 3,600, you're never going to get a chance to buy lower. You better get in. You better get in. Well, after you've been around this thing for decades, that's about the time you better start getting out. I heard the same story at 2,100 gold and $30 on silver. These guys were 5,000 gold by tomorrow, $100 silver by next Tuesday. When it gets crazy, like Buffett said, we're going through a little bit of a cyclone here in March, April, May, and he had a lot of cash and still does. And he said, we'd like to come out the other side of a cyclone with some cash, because then we'll have a better idea of what's really going on. His analysis of using the Russell 5,000 and dividing it by GDP, has the stock market, I think, at a very, very stretched level. And that's why he's not particularly interested in doing a whole lot of just buying across the board, because what he's doing is he's going into special situations that he sees over in Japan. He is going into certain energy investments and other factors like that. And he's a big investor in some of these tech situations as an early investor. I've understood that. And that's the way it's gone. But let me go back to the main point here I'm trying to discuss with you, which is basically, how to maybe set up ways of finding things. Again, we originally back in April, March, knew that the tech sector was, and the consumer discretionary and the semis, and things that had to do with stay at home, work at home, were going to be good. So when you go into some of these ETFs, like the mega cap growth over at Vanguard, VGK, or, the spiders, they all got them. Schwab has them, Fidelity has them. If you want to look for stocks in these type of activities, the tech sector, VGT on Vanguard, the semiconductor, SMH, consumer discretionary over at Vanguard, VCR, they give you the top 10 holdings that they have. So rather than you try to beat yourself up trying to find the stocks, you might look at some of the top 10 holdings that these ETFs that have billions of dollars in them, and see which ones they believe in their top 10 holdings were warranted to have an investment. In other words, they obviously have some belief in them or they wouldn't be in the top 10 holdings. Doesn't mean they have to go up or go down, but it's not a bad lake to fish around, and then apply your technicals to those that they're looking at. Rather than just waiting for some guy on TV to give you a tip, do your own homework. Go look at the sectors you like. Go look at the ETFs that have billions of dollars in it. Go see what their top 10 holdings. Start tracking them. When they have big pullbacks against their moving averages or against support or whatever, that's the time to start picking them up. And if you want to play it that way, that would make some sense to me. Rather than going out there and just trying to play the hottest one you heard last week, because you'll see that a lot of the ones that are in the top 10 holdings are the ones that, the ones that have had the big moves. NVIDIA, has been going on and on and on. Believe me, that's no secret stock. That thing's been in the top 10 holdings of some of these tech and semiconductor deals for a long time. Why? Because they've got the consoles that they got, and they're all this gaming going on. These kids were out of school. I mean, the gaming stuff was going nuts. Who makes money on the gaming? NVIDIA is one of them. Just like 5G. Is Verizon going to be in 5G? Probably. What about Qualcomm? What about Broadcom? These are companies that, probably would have something to do if this thing is going to happen. Apple, obviously, people, are looking at 75 to 80 million phones that they're trying to order for the next series. Some people say that wearables only have 5% of their existing clients using them, which means there's a lot of potential there. So when Apple goes down towards this 200-day moving average, which is anywhere between 80 and $100, which the 100 point almost was hit, 103 is close enough, you can start taking a bite and try to use 80 to 100 as a point where maybe you'd get in at that point and see what happens. Again, try to stay away from the buy the high and sell the low. If you're a believer, the market's in my view, it's a secular bull market. Okay, in our view, the chart doesn't lie. The blue line's rising. The market's above the blue line. We're in a secular bull market. And it's a bull market that's been going on since we turned in 09 and 10. And it's been going on. It got violated a couple of little times along the way. Got violated big with this COVID. But what did the COVID actually allow the Fed to do? Do you think they could have printed $44 trillion worth of GDP, 44% of GDP, unless we had a crash? Do you think Mnuchin could have set up 14 facilities to buy all these debt instruments if we didn't have a crash? Who would have agreed to that? The last time we had a crash in '08, they had 3 facilities, 5% of GDP. They want to keep this thing going. They need liquidity. Where are they going to get liquidity from? The guy who can create it out of thin air, the Federal Reserve. Federal Reserve has a 1913 Act, doesn't it? Right. There's laws in there. They're not supposed to be buying this, that, or the other. So the facilities allow them, to my understanding, I could be wrong, but to my understanding is it allows them to loan money to the facilities who then go out and buy the stuff. Straw man, the middleman, whatever you want to call him. That's what's going on. That's what's going on. So, basically, you don't want to fight the tape. You don't want to fight City Hall. They want to keep rates low for a long time so that everybody from the gray hairs to the crew cuts have to take risk, or else they make no money. That's the game they're setting up. So now people are buying corporate bonds as if it's money market. It's not. They're getting into stocks to try to make money because they can't make money elsewhere. They're buying into gold to try to get capital gains because they can't make money in this money market. So the net result is everybody is now rolling dice in some way, shape, or form. Because you can't stay in the money market at zero unless you have so much money that obviously you don't need to make any income on it. And then alternative investments like the gold and silver and art and everything else is obviously getting a bid as well. So you start out with growth and you start out with mega cap growth. And then you go into your tech sector, and then you go into your semis, and then you go into your what? Your consumer discretionary. So when there's a stampede of the consumers buying, you're going to be in those stocks. Nike's been doing great, right? All right. Now, my personal opinion and Option Professor's personal opinion is that these tech shares, while they still have obviously a lot of upside, their valuations have already discounted quite a bit of that in our view. So while they could keep going, and obviously probably will keep going, their pace of growth may not be quite what they have been. Simple math. I mean, their earnings and revenue, again, have got to, and the valuation, let's look at Apple. It used to be 20 to 1 PE, just almost hit 40 to 1 PE. Okay? You got to run pretty fast when you're 40 to 1 PE, or the rates have to stay low, and I'll get to rates in a second. But the point being is what? Where's the next possible move? Here's my view. Here's our view at Option Professor. Value, which means what? It means the banks. It means healthcare. It means industrials. It means material, and it can mean energy. Okay? These sectors generally pay dividends, which means now the dividends can be cut at any point and they could go bye-bye. There's not guaranteed. But the way they are now, they pay dividends. Chevron, 7% dividend. Could get cut, but they seem like they're going to try to defend it right to the end. Some of these high yield ETFs, 3.5% cash flow. Verizon, good cash flow, right? So these things they're going to give you income while you're holding it. And all those people that don't get any income in the bank, they're going to view utilities and they're going to view these name stocks in those sectors I just mentioned who pay dividends. They're going to view them as value because they're going to be thinking the economy will get better as time goes on. And they're going to be thinking that these companies that have not caught a break because we're still half locked up is going to have a lot of runway once the word vaccine is part of the vernacular and therapeutic. And once the election's behind us and and once the stimulus comes out. They're going to really like those things, a lot of people think, and I'm one of them. Now, they've had opportunities to get above their moving averages. And let me show you, I'm going to put up a chart now so you can see one of them. This is called mega cap value for Vanguard. So this is a mega cap value ETF. Okay. Now you'll see, and this is typical of many of these. You see how this is the 52-week high up at 90 almost. This thing has been trying to get through the red, the green, and the blue. Where are those numbers? They're at 77.5, 78, 77. So this thing's got to start trading above 78, 80 and hold. You see it got up there, peaked in, and boom, right down. We want it to hold up there, and then we think it may have a situation where it could approach here. If not, here's the risk. If this thing rolls over and starts coming down here, well, that means, and believe me, we're on a tightrope because look at the RSI. Where's your RSI? 50. Now look, when you're in a bull market here, where's that RSI all the time? 63, 60, 70, down here, 63. So when you're in a bull market, the RSI tends to be above 50. This thing breaks down from here. I think it's going to be telling you that we could have a slowdown. And if we have a slowdown, I don't see tech going through the roof if we have a real economic slowdown. So we're right on the ledge here. That's why that stimulus is very much needed. So we think at Option Professor that we're going to break out to the upside and that 50 is going to hold and there's going to be a lot of movement up towards 75. You know, like here, RSI was 83. Okay, when it goes up there, look at kind of pop you get. Okay. So if we do break above here and get going, you're going to get a good cash flow on your money if the dividends continue to pay on many stocks in this area. And you're going to get capital appreciation if it can take off. And just going back to where the highs were before the crash, don't forget, tech has all blown that area out. Just to go back here is $15 away. What's 15 on 76? That's going to be about 20%. Right? So 15, 20% plus the 3 or 4% you get on the dividend, that's not a bad deal. And at least you're getting them when they're closer to the moving averages, not buying them way away from the moving averages, not selling them way away from the averages. So that's why I'm trying to show people that, hey, we're patient people. They tried to get us suckered in there, but we said, let's wait and see where they take it home. You notice that month that they had it up here? They took it home way down here. That month was, I think it was September. Yeah, they brought it up to 81, but they took it home at 76. Because they got a lot of people to buy in, right? And then boom. So again, that's where we're thinking the value is going to come into play. And that's something we're taking a look at. Now, value comes in many different shapes and forms, just like growth does. In other words, you could go into growth and you could go with small cap growth, or you could go with mid cap growth. Just to give you an idea, small cap growth on Vanguard is VBK, mid cap is VOT. Okay. Those have also gone very aggressively to the upside in the last 8 months. Okay. So you can go with different, shall we say, capital sizes or capitalization sizes, small cap or mid cap. Same thing on this. You got a Russell 1000 value, VONV. We're watching that closely. Russell 2000, VTWV, watching that closely. They're all very close to turning if they can get some boat legs in the next few months. And again, their dividends are way higher than you're going to get by just having some short-term paper. Yes, there's risk because you're buying a stock here, but if you're going to take a risk, at least here you're going to get a dividend. And if the economy does turn, there are those who believe these companies will start participating at a higher rate. You've got a S&P value, VOOV, okay? And you've got IWM and IYT as your transports. So there are different ways to go on this sector. And that's where you're going to try to do the growth end. Now, there's individual sectors that I keep an eye on, and we keep an eye on all the time. Energy is VDE for Vanguard. That's their energy. Obviously way down and getting killed now. But again, as Buffett was saying in one interview, there's a lot of cars out there, and they're not going to all turn electric overnight. Now, this week we have something where Libya is coming online and supplying some oil, and they're concerned that the slowdown in the credit card activity and the bookings and all the rest of it, the durable goods, is going to translate into lower oil demand. So those are two punches in the stomach that oil got this week. Libya decided to start exporting quite a bit, and also, the stall. They're hoping stall doesn't go to stop. Another one is communications, VOX. People want to get into that because obviously communicating is going to be very, very important. And they think some of the telephone companies and some of the people that are involved in telecommunications could make out because of it. Real estate on the REITs, some people still think there's value there. Why? Because if the dollar is going to go in the tank again, which our belief is that after this rally it's going to, then you're going to get a rally in gold, which I'll talk about. And the REITs are going to do better. And don't forget, the REITs can also include big data, or distribution centers and things like that. So it doesn't have to be, coals in there only. They could reset up some of these malls and retail and commercial centers for big data. That seems to be, and digital realty. So that's something to look at. The utility sector. People are thinking the utilities are going to be fine. VPU is the one over at Vanguard. And they pay good dividends, and they're pretty steady as far as you got to pay your utility bill. And if there's an infrastructure bill, what do you think that's going to do to what? Utilities. Probably help it, I think. That's in my opinion. You got your financials. These banks some of them are trading at ridiculous discounts to book. Citibank being one of them. Yes, they had some AML problems in the audit, but those are supposedly well known. They've set aside a ton of money for these bad loan losses. Is it enough? Right now, it's more than enough because they haven't come down the pike, but they could. But if they don't come down the pike at the same pace, then what? Then they're going to have a lot of cash. And here's the key to value, and here's the key to the banks. The long bond, which is at 145, if that yield were to steepen, now why would the yield steepen? Because somebody's going to wake up one day and they're going to say, I loaned who money for what? 1% interest, and they don't owe me the money back for 30 years? And I'm getting 1% a year, and he gets all my money, and he only has to give it back 30 years from now? And I'm getting one lousy percent? And what is he going to pay me back with, $1? Well, the dollar just dropped from 104 down to what? Almost 90. Now it's bouncing back up. But what if it rolls back down? Because they can see we're going to have structural stimulus as far as the eye can see. Then you're looking at what? Possibly a rendezvous in the 80s or the 70s for the dollar, and that's going to make those yields rise. And I don't think the Fed, my opinion, our opinion at optionprofessor.com, is I don't think the Fed would mind that, because if you have a flat yield curve, you cannot get money velocity going. That's why Europe and Japan has no inflation, because their rates are flat across the board. If you get the yield at the long end up, then the banks have a curve of which to make money against. That gets them in the game. When they're in the game, money velocity gets up. When money velocity gets up, then the inflation comes back. They want inflation back. It's a mandate. That sounds important to me. And that's why the gold is big potential looking down the road, because that probably will be bad for the dollar. And if the dollar goes south, that opens the door for what? For things that are valued in dollars to rise. So the value sector, okay, and the banks in particular, I think would benefit from yields rising. And in the next 3 to 6 months, it would not surprise me to see that happen. What else? Now, let's talk a little bit about healthcare, VHT. That's also part of the value area. And then you can turn towards the international. International, you go with emerging markets if you want to participate in that. You can go with Asia and the South Pacific. You can go with just Europe, where they tell us that values are quite low. Or you can go country to country. Some of the countries that export because their currencies are in the tank, they're doing pretty good. Some people think that Brazil might do good because of that. Some of the other international emerging markets might as well. So there's other ways to look in those areas as well. And that's why you try to keep, that's why at optionprofessor.com, we follow many things because opportunities are all over the place. They're not always happening at the same time. With regards to some of the ETFs that I watch and we watch, VEU is a big international one. VWO is emerging markets. VPL is your Asia, South Pacific. And then you've got international dividend, VIGI. And then you've got international income. Some people like to buy debt in foreign, overseas because the yields are higher. And some people have been buying the international debt, emerging market debt. VWOB has that. So you investigate and then you invest. You look at the prospectus, you get all the details, you make sure it's suitable for yourself, and then you proceed accordingly. With regards to short-term corporates, a lot of people look towards VCSH, which trades for short-term corporates. And they try to stay, 0 to 5 years or something like that, ballpark figure. Some people look at the preferreds, which are issued a lot by banks, PFF. And some people are looking at the junk bonds, which they've gotten away with because spreads are in the 500 area. And some people think it's not going to hit 600, they're going to hit 400 first. But they do recognize that if stimulus doesn't happen, the earnings go south, and we have another virus spike, that's another big risk, then you got to change your calculus. Because obviously those are wild cards that can change everything. The tax-free bonds, of course, they've been doing pretty good. Although some of the states and municipalities seem to have their problems, they seem to be working through it. Part of the deal the Democrats want, I guess, is for some relief to the states. Some people think that it has nothing to do with COVID. How could it not have something to do with COVID? People aren't going out to eat. They're not doing the same thing. So the revenue's down to the state. It's all COVID. Sure, they had some problems beforehand. Yeah, but they didn't have the same problem they have now. So you don't have to, bail them out for everything. But I think, you can't just abandon the states when they have these kind of shortfalls, because obviously without COVID, they wouldn't have had this type of shortfall. That's the whole thesis. And again, if they get money and they spend it, the people who get money will spend it. So it still churns around the economy. It's not like giving money to a foreign nation and you never see it again. It's not like buying a bunch of tanks that we haven't used. This money will go into people and people who spend money, and they get money and then they spend it, right? So, the municipal bonds, could have a rough ride if they get squeezed out of the stimulus package. So basically, those are some of the things that I and optionprofessor.com keeps track of. Let me go a little on a sidebar here because we do a lot more than just that. We also look at thematic ETFs. Like, I'll just rattle off some things. ARKQ, ARKK, SNSR, cybersecurity, ARKG, and clouds, of course, WCLD, and CLOU. Obviously, that's the way we try to keep track of, precision medicine. How do we keep track of robotics? How do we keep track of Internet of Things? That's how you participate in those things. Those things have had big run-ups. If they have big pullbacks, it might be worth to take a look, because they had huge up moves, and I think they have pulled back in many instances, and we're keeping track of that. Also overseas, China, KWEB, KWEB, keep track, that's the way to get involved over there with some stuff. JD.com. Of course, you've got Baba, everybody knows that, and Baidu, and stuff like that. So we keep an eye on those things. And of course, we're very big on the sports gaming. I'm very familiar with it. And DraftKings and Penn Gaming, and even BJK, which is a conglomeration of a bunch of things, Churchill Downs. These are ones we've been on top of for a long time. And they have really got a lot of money coming in because, again, millennials like to bet and they don't want to really go down to a sports book. So they like to do everything online. And I talked to some people who go to the sports book, and what do they tell me? They tell me, I used to do it online, but I get so addicted to it, you end up betting every jump ball. And that's the kind of stuff that makes these people a lot of money. William Hill, another one right there. So, and then the epicenter stocks, Starwood Hotels, STWD, Car, which is Avis, and Budget Rent-A-Car, Jets, that's all your things. At some point, they're going to be of value. They've had runs, but they stall. They're stalling because the dollar's getting stronger. There is no stimulus package. We've had a big run, and the unemployment rate is going to be stubbornly high, so it's going to stall. But after it stalls, as we work through it, these should have some legs down the road. Starbucks was one I really loved when it broke into the 70s, and now it's in the mid 80s. I think, and OptionProfessor.com thinks that we could see a good movement there in the months and weeks and time ahead. There is also an ETF of focusing on millennials, and millennials basically, it's MILN. And what they've done is they figured out where they like to spend their money, what they like to do. So they've done all their research, and they've come up with companies matched up towards the interest of millennials. And it's been doing very interestingly well. And on a long-term basis, it might be a heck of a thing to hold on to, because millennials are going to be the most powerful force in the next 5 or 10 years. Why? Not because they live with their parents, because they're going to be inheriting a tremendous amount of capital. Okay, and when they inherit all that capital, they're going to probably want to put it to work. And that's going to be a lot of buying power, and especially into companies where they spend money in things that they're interested in. So millennials, a big market force, and MILN is trying to track them. Also, payment services, iPay is something that we follow. And of course, you've got Square, and you've got PayPal, which is banking the new way. And then you've got the other ones like MasterCard and Visa, who are obviously modernizing quite a bit, but they are more old school than the other two. But obviously, Square and PayPal, have been the new dogs on the street in the last 5 years. So basically, that's some of the other things that we look at to keep track on things and get a little bit of an idea of things that are off the grid from just income growth speculation. Now, I'm going to button this thing up here by going into a couple of other markets that that we follow each week. And we talked about crude oil. Again, crude oil got whacked here. Again, Libya's coming on with more oil, so they're concerned about that. And then, of course, everything's in a stall phase economically here a bit, so they're concerned about that. So the demand and the extra oil has got this thing back under 40. Our opinion, our view is this thing is going to stay above 30. And next year, when things get a lot more towards normalization, you're going to see the demand kick in, and you're going to see the prices reinstitute to the upside. So again, when we were down negative $37 on crude, when that guy got caught with all his futures contracts, obviously we thought there would be a bounce back towards the 40, 45 area, which we saw. Now we're getting a pullback into the 30 area, and we think the 30 area could go into the 40s or 50 area or beyond, based on how strong next year's recovery is. If it's very strong, going into the 40s and 50s seems to be a pretty good bet. So that also would mean try to keep your eye on the Chevrons of the world and see if, in fact, there's value there. Kinder Morgan people like to look at as well. Schlumberger people like, they're all dogs right now. But, Chevron's paying you 7% to pet the dog. So bottom line is that, don't discard these people, because every time you leave the house, everybody in those cars out there, they're using gasoline. So except the percentage that's in the electric cars, which again is dwarfed by the others right now. With regards to, we go over also the gold, silver, and copper. Now, the gold was this. When we broke above 1,500 on gold, 1,350, I think actually it was, above 1,350, that was your green light to get into the gold. Then, of course, the dollar had the 10% drop, and everyone went nuts with the gold. And look, it went so far away from its moving averages, it was a joke. So let me just give you a little rundown on the metals, and we'll close out with that. Okay, and I'll give you what I'm seeing here, because I think gold's got a lot of potential. But again, the premise is September, October, and November are risk months where you might get some very exciting opportunities. Let's take a look at the gold so you get an idea. All righty then, here you go. Yeah, you don't want to be buying gold at 2,100 when the moving average is down at what? Where are they? 1720. Now 1720, I might be very interested, right? As it gets towards there, it went under 1900 into the 1800s lately. And then down here, you're way down here. You know, it tends to come back no matter how far away from the averages. At some point, it tends to come back either to the red or green line. Let's look at the last big run up in the gold here. Okay. It broke up. It told you to get in at 300 bucks, right? It stayed above the red and the green all the way here, tested the blue. Got back above the red, just ride it, okay? Broke down to the green, came back up, couldn't do it. Now you break under the blue, and it's time to get out. You get out, and it rides it down. Tells you to get back in pretty much in this area, like I told you, 1,300, 1,350. Once you broke 1,400, that was the go sign, okay? And there you go. Now you got a high surrounded by lower highs. So again, gold is digesting. I think it's more digestion to come. Obviously, you keep core positions that you never sell. But if you're looking to add, I'm hoping that you're going to get a good price. And I'm hoping because the price, when it's up here and the moving averages are down here, it tends to come back and test. Let's look at your silver. Silver, December. And again, you got GDX, and we cover all this every week in the letter. GDX, GDXJ for the juniors. In copper, we got Freeport-McMoRan, FCX, you know. Okay, on silver, again, as long as it stayed above 24, I thought it still looked good. Once it broke 24, I still think this is, so I'd be liking this thing anywhere between where the average is, which is 1950, and around 20. And I don't think it's going to take this out, which is your 17. So basically 17 bucks it should be your worst case scenario in our opinion. So anytime you could get it between 20 and 17, it would be a bargain. And coming down to test the breakout point is something that things sometimes typically do. So see if you get lucky and it goes down there, because again, we do think the dollar is going to resume its downtrend at some point. And let's take a look at that real quick. So you get an idea where we're coming on that. Dollar index. There you go. Because again, I think this is a very key thing. And here's the other thing. Our opinion is that the value of currency looking forward is going to have a lot to do with your deficits, your trade deficit and your fiscal deficit. And we're going to have a doozy on both. So it's going to be hard to have a strong currency when your trade deficit and your fiscal deficit are off the charts. Now, this thing has crossed all the lines here. So could it go up towards the moving averages, which is around 96, 97? That's the upper band. It could go up there. Do we think it's going back to 100? Absolutely not. So if it does do that, I got to change your calculus. But our opinion is that this thing was a high point and it's going to be able to matriculate lower. And where's the breakout point here? 85. You see that? So what are we saying here? We're saying our opinion is you could see 85. And if you saw 85 or 80, our feeling would be that that would be the instigator to get the gold, stocks, anything that's valued in currency, dollars, to go higher. So basically, that gives you a little bit of an idea on what we're seeing. Copper got a big hit today, but, you know, I'm going to put up the copper chart, and it should be no surprise because, you know, we were talking about copper when it was at 220, not at 320. And we were talking about Freeport-McMoRan at 5, not at 17. So pullbacks on bull markets, you're going to try to get into. This thing lost about 5% of its value today. But as you can see, it's still above the averages. You'd want it to basically stay above 260 area. And as long as it can stay above 260 and if the RSI can stay above 50, those would be two positive things. Don't forget, whether you're doing day trading, swing trading, intermediate trading, or long-term trading, you like to see the RSI on whatever chart you're looking at above 50 if you're bullish and under 50 if you're bearish. Now that can be obvious, and you'd like to see if you can see a divergence where you're making a higher high, but the RSI is not making a higher high. Sometimes that's a good indicator as well. Same thing on the upside. You're making new lows, but the RSI is not making a new low, then you're all set on that side as well. But yeah, that gives you a little bit of an idea. Let's put the cues up there as a going away present here. And there you see the cues. Again, way away from the average. That's why people think it might at least come down towards 240. Anyway, only time will tell. Our thesis is September, October, November are going to be dicey, and so far they've been a little bouncy and dicey. Will we get more to come? We'll know soon enough. Our line in the sand on the S&P right now is around 34.28. If it got above there, we'd have to change our calculus possibly. So that would be a line in the sand, December middle high. What I'd like to do now is just let you know that each week you can get a free copy of the Option Professor Weekly Market Update. How do you get it? You simply go to the website, optionprofessor.com, and then you put in your information, and then you put in the queue, and then each week you'll get an email which will have a copy of the weekly update. And we cover, as you can tell from this broadcast, we cover a lot. I haven't even talked about the Elliott wave stuff that we watch, as well as Fibonacci number as well. But what we try to do is we try to give you things that make sense, and we try to put them in some kind of technical perspective. We do focus a lot on the moving averages because they're based on price and time, which means they're changing, and they're based on factual information, price and time. So we do find those very attractive. And of course, we use the RSI as a helper as well. So again, optionprofessor.com, go there and get your information in. And then, of course, there's other features and benefits you can learn about after you get your weekly update on what we can bring to the table for you. And, of course, you can email us anytime you'd like at optionprofessor@gmail.com. It's been great to give you an update. I certainly went over a lot, and I enjoyed it. I hope you enjoyed it. And until next time, this is optionprofessor.com signing out, and I'm going to send it right back to David right now.